your day smarter and celebrating 10 years of keeping you better informed. 106.1 FM Talk and News Talk 94.5 WPTI. More with KC starts now.
So you don't have to be even invested in the market 1 cent to not watch the numbers as they've come in the last few days. It's pretty overwhelming, especially with a market that's built up to nearly 30,000 as the Dow was, because a lot of times people forget that context matters. And so when you read a report that says, it's the largest point drops in 124 years in whatever the span was. I saw some article out there. However, the points and percentage are two different things, and it's important you know those. But it can be overwhelming trying to figure out, well, what do I do, especially if you find yourself in a situation where, I don't know, you're already like having the retirement conversation. Well, that's why I wanted to bring on somebody who can kind of help give us a little background on what's going on and how folks deal with it so we don't run around like a bunch of headless chickens. And that is host of, on our Greensboro side, the weekend show, The Wealth Guardians. And it's Doug Ray joining us. Good morning to you, sir.
Good morning, and TGIF, KC.
On the potatoes, you seem less than pleased.
Well, I could have woken up and listened to something completely different than that this morning. But,
okay.
Whatever.
All right.
It's definitely not a slow news day.
That's what you get to follow. You also get to follow does your phone just start blowing up when all this stock market stuff's going on?
Actually, no, because, we've got our clients positioned to the point where we're hedging the downside. So they're pretty comfortable in this environment. And I've actually been warning them that I thought this year was going to be a volatile year, but that was because it was a general election year.
Yeah.
What we're looking at right now is the Black Swan event.
Though, and let's put this into perspective. The president was asked about it during his presser the other day. We've seen a lot of talking heads there. You don't disagree that it's a combination of things, but in large part, with these big tech stocks like the Apples of the world, which have driven a lot of the growth, by the way, when they're looking at a situation where they're not going to be able to get a hold of their products, get their products out, and they're going to have quarterly financial reporting that's not going to meet expectations. These are investors looking ahead to that, and it's having an impact on the market, but there's also other things going on. So what say you, Doug Ray?
Well, I think a lot of that is absolutely built in there. But, the markets are very efficiently pricing in known bad news and known good news. What they're not efficiently pricing right now is the unknown, and you just spoke of it. How badly will this virus affect the supply chain coming out of Canada? Right now we have not seen short supplies, but if this thing continues much longer, you're going to see some short supplies. That's going to have a negative impact on earnings for sure. Goldman Sachs came out yesterday, and they thought we'd see negative growth rate year over year. What I tell you, what I'm looking at right now, not so much the Dow Jones, I'm looking at interest rates and the price of oil.
Yeah, price of oil took a big hit, didn't it?
Oh, it's almost in a bear market, which obviously that is forecasting much slower economics. And so is the interest rates. We hit an all-time low on the 10-year Treasury yesterday, and it looks like it's about to open up at another all-time low.
What should people be doing? Running around and yelling, sell, 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 flinging on themselves out a window? A correction on average, correct me if I'm wrong, results in a drop of 14%. And I think people need to be dealing in percents and not points all the time. The comparison is just impossible. Do you think we're looking at something like that?
I think it could be. I think it depends upon where we see stabilization. I expect that we're going to see a coordinated central bank effort to supply liquidity to the market probably any day now. That'll be a temporary solve. But what has to happen is we got to see where this virus is going, what the extent of it is, so that markets can then start to price back in something close to normality. But, corrective modes typically start around 10%, at least that's how it's defined, and then the bear market is 30% drops in the overall price.
All right, well, let me ask you this, because I heard a stat, you tell me if it's right, that if you take any 10-year span within the market, there's no loss, right? If you're is that stat accurate? I've heard that before, that in any 10-year window, if you're investing in the totality of the Dow, you wouldn't lose money, because that's just the natural ebb and flow. The problem is we got a lot of people listening that they're 10 years away from, or they're less than 10 years away from a major transition. Retirement, obviously, being one of them. But they're looking at it, they're remembering 2008. And if you remember back then, people who were staring at retirement 2-3 years down the road didn't get to retire, in many cases, 2 or 3 years down the road. So those are the people that I guess I want you to address. What should those people be asking their financial advisor or whoever it is about?
Well, you're absolutely right. I think your statistic is pretty close to accurate. Since the Great Depression, on average, we've had a bear market about every 7 years. The ones who are affected the most are exactly the ones you just pointed out, those folks who are in retirement, or those folks within what we call the retirement red zone. That's about 5 years ahead of a retirement date. If you lose 25, 30, 40% of your 401k, that can be devastating. What should they be asking? Well, they should be asking, where am I positioned? How much risk do I have in this portfolio? Does this risk meet my own risk tolerance? What are you doing to try to defend the downside? That kind of thing. I don't believe in the buy and hold approach. I never have. There are things that we do now to help mitigate the downside volatility, and that's something that I think folks, especially retirees and pre-retirees, need to be asking their advisors. How can I mitigate the downside volatility? Because we don't know where this thing is going at this point in time.
Right.
It could end Monday, or we could be in a full-fledged bear market in a couple weeks.
Yeah, well, it's real easy to not care when the roller coaster's climbing the hill. You know what I'm saying? That's fun. Oh, that's great.
Casey, we've gone 11 years now without a major downturn in this market, and people are incredibly they don't have a clue. They're just got into this cozy stock market. My 401k is going up every month. I'm happy.
I don't mind the stuff I'm getting sent. You know what I'm saying? When I get those little reports, everything's hunky-dory, man.
It makes you complacent.
Yes, it does. Well, so let me do this. Your website is The Wealth Guardians, or wealthguardians.com. I know
wealthguardians.com.
Yeah, and you have a book out too, right? Or you teamed up with was it Jack Canfield?
That's exactly right. Yeah, he asked a bunch of advisors across the nation to help him do this book, especially for retirees, and I'm proud to be a contributor there.
Okay, and if folks want more information or a little sample of what you're doing, you have that on your website too, so folks can look at that. And your weekend program on WPTI, of course, they can check that out. But I thank you for coming on and just trying to provide a little normalcy to this, because everything's on fire when I turn on. Everything looks like Jim Cramer's show right now, even when it's not. So
you're right.
Yeah. All right, Doug. Thank you very much. Appreciate it, sir.